Hey traders, Jason here from Leavitt Brothers. Happy Sunday. In this video, I'm going to do an update on my State of the Market series. Obviously, a lot happened last week. First, a quick reminder. I'll be speaking at the Traders Expo in New York next weekend. If you're around, come check it out. Say hi. I'll be talking about sector rotation, using sector rotation to outperform the market. It'll be at the Marriott at the Brooklyn Bridge, March 7th to 9th. I'll be speaking Sunday night at 5:30. Registration is free, so come check it out. Say hi. All right, let's move on. The market fell last week like it has never fallen before by several measures. The selling off the highs was more intense and severe than any other drop off the highs in history. Nobody could have predicted what took place, but we definitely knew something was coming. I talked about it in last week's video. So in last week's video, I said the following. Short term, there are definitely warnings. In fact, I'd say something doesn't feel right. I'm playing it very safe right now. I don't like what I see in the near term. Something seems off. If I'm wrong and the market surges next week, so be it. I'll miss some opportunities, but I just don't see a reason to be super aggressive. I don't even see a reason to be moderately aggressive. If you ever wanted to take a little time off, now is a pretty good time. So I said that in last week's video. In my report to subscribers at Leavitt Brothers, I said the following. Something doesn't feel right. Long term, the market is in great shape. I have no doubt the trend will continue, but in the very near term, the market feels on edge. Short term, it feels more fragile and susceptible to sudden shocks, whereas in the past, a gap down induced by bad news would get bought. I'm not sure a gap down would definitely get bought right now. It can get worse quicker and more easily than it can get better. It is what it is. Don't fight it. If you zoom in with blinders and have to make money now, you end up forcing trades and wearing yourself out. But if you recognize the market has rallied almost uninterruptedly for 5 months, you think in terms of a rest, setting up another round of fantastic trades later this summer or next fall into the election. So I'm not going to repeat the indicators I talked about last week. You can go view them. You can go watch last week's video. Okay, so here's a YouTube screenshot, last week's video. You can see posted February 23rd. You can go re-listen to that where I talk about the indicators that I was looking at that enabled me to make those comments. So instead, today I'm going to just talk about what I see right now and what I'm looking for going forward. All right, so let's get into it. So here is the S&P daily. So obviously we had a big, this is S&P daily going back 1 year. So we had a big rally here, January, February, March. We started to kind of settle into a range. And you can see here we had, you can draw trend lines like this. We had, kind of a triangle consolidation pattern, late summer, early fall, huge rally, November through, through most of February. And then we just got crushed. 50-day moving average, no match. 200-day moving average, no match. All the gains given back. So this looks pretty nasty. I guess you can say like, hey, maybe we get support here. I don't know. Maybe not. To me, this plunge is so sudden and so severe. I don't know how anyone could just randomly say there's support. There's potential support. To me, this is just in no man's land. Too much emotion. It's not a predictable chart. Okay, so let's back up and look at the weekly chart. So here's the weekly. So you can see the 50-week moving average has always been important. So we got support here, support all through here, sloppy resistance here, support, kind of support there. So we closed below here. Okay, so if indeed the index gets trapped below the 50-week, then we got some problems, okay? So if we can bounce here and then establish itself up here, that'd be great. But if it bounces, gets rejected, and comes back down, then we got a problem. In that case, I start looking in terms of like this big void space here that's in between the 50 and the 200. You can see the 200 week was support here, the 2 was support there. So if indeed last week's selling was just kind of a warm-up or maybe just like the first part of a two-part sell-off, then I'm going to be looking for this void space in between the 50 and the 200 to get filled. Okay, it's all going to depend on if the index gets trapped underneath the 50 or not. So we'll see what happens. All right, now let's back up and let's back up one more time and look at the monthly chart. So here's the monthly. with the 50-month moving average. So we got some support here, resistance there, support, resistance, nothing really going on there. But we definitely have some support here, definitely a support here. And so, again, like the last chart, if indeed the market can't bounce, then I'm going to be looking for the void space between the current price and the 50-month MA to get filled. So if I compare these two, if I go back to the weekly, the 200 here, the 200 on the weekly is at 26.32, and then the 50 on the monthly is 25.82. So they're exactly 50 points apart. So that the range. So if I were to draw this out, it's 26.32 and 25.82 between those two charts, the 50 on one and the 200 on the other. It gives us a 50-point range, which for the S&P, 50 points nowadays is like that could happen in an hour or so, just in the morning. So if indeed things get worse, I'm looking for the void space here to get filled, and possibly those very longer term indicators which haven't been tested in a while to get tested. All right, now let's look at some indicators. All right, so here is S&P 500 versus the 10-day NYSE 80 line and the cumulative line. All right, so you know that when the market trends up, you get steady prints above zero, okay, and then a dip within an uptrend, you get these minor prints here. Okay, the fact that it's dropped so much tells you this is not a dip within an uptrend. It could be the beginning of a downtrend. So what I'm looking for is on the next bounce, and there will be a bounce soon, if this thing can get above and then stay above, the market will do fine. If it gets above but then immediately falls back, then we're probably going to get another leg down. Okay, that's what I'm looking for. Instead of guessing, let the indicators guide us. A bounce could definitely see this get above zero, because this is only the 10-day. So as bad as things are, once you start removing these days off the calculations, you could easily get this thing above zero, even a high print. But then it needs to stay there in order to confirm that a bottom's in place. The market's going to actually leg up. A bigger warning, a longer-term warning, comes from the cumulative line down below, where it actually just took out its 50. Okay, if we look back to the fall and winter of 2018, you can see with the 50 here, it went below. Okay, and when the market bounced here and bounced here, the indicator got rejected by its 50 and then rejected by its 50 and continued on. Okay, so what I'm looking for here is if we can get back above the 50, long term, the market should be doing fine. Okay, but if this thing gets rejected by its 50 and rejected by its 50 as the 50 kind of swoops in like this, then the market's going to head further south. Okay, whatever happens right here is going to tell us a lot about what's going to happen over the coming months. All right, next chart. S&P, or this is the Nasdaq. This is the Nasdaq. The percentage of Nasdaq stocks, Nasdaq 100 stocks above their 50-day moving average, and down below is percentage above their 200-day moving averages. Okay, so first of all, we get divergences help us here. Okay, we got higher high here, lower high here. Market sold off. We got market trending up here, lower highs there. We got market going up here, less stocks above their 50 here. So good stock. It's a good indicator for warning us that a top is forming. So what we're gonna want to see here is we're gonna want to see a recovery, and then to be able to hold above 50%. Okay, that's what we want. We want to see a recovery and then a hold above 50%. You just simply can't. The market can't move up if right now we have like 20% of stocks, 20% of Nasdaq stocks above their 50. Like mathematically, in order for the market to move up, while that's the case, those 20 stocks would have to be up huge, and the other 100, or not the other 100, the other 80 or so, maybe there's a few extra stocks in the Nasdaq because stocks like Google have two listings. But you simply can't have a really small number expected to carry the weight. Okay, so when the market bounces, and it will bounce, we'll see how this indicator goes. If we look back to the end of 2018, where the market bounced here, we got a bounce here, but it couldn't even get, where's 50%? 50% line is like right here. So it bounced, but we couldn't get a very high print. It bounced again, couldn't even get above 50%. And it wasn't until we got above 50% that we could actually start a rally that lasted. Okay, so that's what I'm going to be looking for going forward. When the market bounces, how far can this indicator go, and can it hold a decent level? All right, next chart is similar situation with the S&P and the percentage of S&P stocks above their 20, 50, and 200-day moving averages. I'll go through this a little quicker. Again, we get divergences kind of help us, you know, higher highs here, lower highs, again there, again there, and then we got another one here. Okay, so now same thing as before. You get prints above 50%, prints below 50%. You know, kind of like this tell us that it's just a dip within an uptrend. Okay, but when you get a big plunge down like we did here, it's no longer a dip within an uptrend. It's a downtrend. So how it acts going forward is going to tell us a lot. Okay, when the market bounces, can this get above 50% and stay there, or is it going to get rejected and come back down? That's what I'm looking for. You can see you know, in 2018, it got above, but then it lost it. It got above, but lost it again. As far as percentage of stocks above the 50-day moving average, barely got above, lost it, barely got above, lost it. But going forward, once it got above over here and actually was able to stay there, then that's when the market rallied. So instead of guessing, like, is this bounce going to last? Like, why guess? I mean, just look at the indicators. If a certain number of stocks are trading above a moving average, then that tells you that the market's either healthy or not healthy. So don't guess, just let the indicators guide you. All right, so here's S&P versus average true range, Bollinger Band width, and VIX. I made the case last week that elevated. Well, first of all, I should say that, you know, market tends to move up on calmness. You know, small range, Bollinger Band width, small, VIX low, and then it moves down the complete opposite. Okay, so last week, you know, when the market was moving up here, if I could map this out, when the market was moving up here, the fact that the average true range stayed elevated, that was a warning. Okay, so if the market if the market was calming down, this should have just dropped all the way back down to its lows. Also, a warning was that the Bollinger Band width, even though the market moved up, was starting to expand. So it's another warning, and then the VIX also moved up. So we want the opposite to happen. Okay, we want the opposite to happen. We not only want the average true range to fall, but we need it to fall down here. Okay, if the market rallies and average true range comes down and establishes itself at an elevated level, then the market's going to fall. Okay, same thing with Bollinger Band width. Okay, market rallies, if this thing kind of comes down and settles in at like an elevated level, market's going to fall. Same thing with the VIX. Okay, these indicators, which are a suggestion of volatility and not energy, but like I would say like negative energy, negative emotions in the market, they need to calm down in order for any type of rally to take hold. And if they don't, then we're going to leg down again. All right, last chart. Here's the SP 500 versus new highs and new lows. No surprise that new highs dropped to basically nothing. Well, they're not really nothing, but I don't know what they clicked in yet. I don't have it here. But they're basically at zero. New lows obviously surged. So when the market bounces, let me get rid of that. I would not expect new highs to move up, okay? With this kind of a drop, so many stocks are so far below their highs that it will take a while for them to get back up there. So if the market bounces, I expect this to stay low. Okay, so it's not a warning if it stays down, but I would expect new lows to just immediately plunge. Okay, so if we get a bounce here and new lows plunge, that'll be a good sign. If we get a bounce here, but new lows drop off, but then stay at an elevated level, to me, that's a warning. Okay, that would be a big warning. So over the next week, over the next 2 weeks, if we get a bounce, I want to see this go all the way down to the lows. If it doesn't, then we got a problem. And then if indeed a bounce could last, a week or two, then we're going to want to start seeing an expansion of new highs. And if we don't see that, then there'll be problems there too. Okay. Again, let the indicators guide you. Don't guess. Is this a top? Is this a bottom? What do you think is going to happen next? The indicators will guide us. Okay, so to sum everything up, long term, I think we should still consider the trend to be up. Shorter term, enough damage has been done and the indicators have fallen to low enough levels to support a bounce. But whether a bounce is just a bounce within a newly formed downtrend or the beginning of a recovery will be hinted at by the movement of the indicators. Okay, do they recover to acceptable levels or do they get rejected and roll over? We'll see. For now, be flexible. The S&P can bounce 200 and then give it all back, or it could just plunge another 200 next week before bouncing. I don't know. Be flexible, be open-minded, don't get stuck in your ways. Things can certainly get much worse, but I personally don't underestimate the resiliency of mankind. Okay? I'm not that negative, even though the sky seems to be falling in the near term. Thanks for listening. You can follow my YouTube channel by clicking the red subscribe button, and come say hi at the Traders Expo if you're in New York. I'll see you next time.